Hi, CUTV people. If you remember from last week, I talked briefly about the PASS program. My name is Dave Byrne. I'm a third-year accounting student, and I run PASS. So PASS stands for Peer Assisted Study Sessions. The workshops held twice a week. Each workshop is an hour and a half long. Each workshop is the same, so you only need to attend one. We just offer two options because obviously everybody's got conflicting timetables. PASS is anonymous. We do take your information when you're there for our own statistical purposes, but your prof doesn't know you're going. What is PASS not? PASS is not a tutorial. I'm not a TA, and PASS isn't mandatory. It's completely voluntary. PASS is also, it's not remedial. It's not for weak students, it's for strong students and weak students. It's for anyone who wants to improve their grade. What do we do in PASS workshops? Well, accounting, like I said, I'm a third-year accounting student, and it's best learned by doing the problems. In lectures, it's usually the prof doing the problems on the board for you, and maybe you're paying attention, maybe you're not. But when you come to my workshops, which are going to be really fun, I'm going to force you to actually practice accounting, which should all be a very exciting idea for everybody. Each week, we'll go over the content from the lecture. So, like I said, accounting is tough. There's a reason this course is supported by PASS. Cool fun fact about PASS. For a course to be supported, number one, the faculty contributes funding. So the business school thinks that this is a good program that's going to help you guys out. And number two, to qualify for the PASS program, the course has to have a minimum 30% DFW rate, which means that in the past, 30% of students either drop the course, or rather either get a D, fail, or withdraw from the course. Now this is a new course, but they're going off PASS statistics for PASS accounting courses. So each week we're going to go over the lecture, see where the sticky points were, and the advantage of me helping you guys out is that I've gone through this course many times. I've worked with Patty for third year now. So I've seen the content. I can help you pick out what's the most important, and we can consolidate the information so that you're able to practice the most important parts and get an A+ with the little bear. We also have practice quizzes and mock exams, which tend to be very popular. And we're going to ask lots of questions until we all understand accounting really super well. Well, Dave, this all sounds great, but why should I attend PASS? Well, the proof is in the numbers. I'll show you in a minute. We have found over the years that students who attend PASS regularly achieve, on average, one full letter grade higher than students who don't. So if you're a D student, you move to a C. If you're a C student, you move to a B. If you're a B student, you move to an A. And I'll show you. This is the graph from Business 2001. Obviously, we don't have one from Business 2003 because it's a new course. But for folks who attended 10 times or more, the average grade was a 9.4, if you can't see, which is in between a B+ and an A-. So you come once a week, maybe missing a week or two, and you're looking at B+, A- on average, which is a pretty good grade, I think. So now we get to have a vote. I need you guys now to look at your timetables, and we're going to vote on the two best times that fit your schedule. Even if you don't think you're going to come, I'll tell you, you definitely will want to come for the mock exams. Those are very popular. So even if you don't want to come, please vote. So I want you to pick two times that are going to fit in your schedule, if they fit at all. And I'm going to record your results. So I'll give you a minute to look at your timetables. Are you guys ready? Yes? Alright. Alright, who can do Monday 11:30 to 1? Just hands up. Okay. Who can do Monday 2:30 to 4? Okay. Who can do Tuesday 4 to 5:30? Who can do Wednesday 11:30 to 1? And who can do Wednesday 5:30 to 7? Quite a few. Okay, perfect. All right. Now, I'm not going to announce the times right now because I do want to give the CUTV people a chance to vote, because I know a lot of the CUTV people do attend courses here on campus, and so you would be able to attend. So for you CUTV people, if you go on the WebCT for this course, I've created a discussion board. It's called PATH. There's one topic in there right now. It's called Workshop Times Vote, and it's got the same list of times. So if you people could go on and indicate the best 2 times, that would be great. And by Sunday, I'm going to give you till Sunday to check WebCT and do a vote. And then I will post an announcement on WebCT for when the workshops will be held. There's the mouse. I know some of them. It's okay. Anyhow, yeah, so Sunday. What do we have next? So workshops, yeah, they're starting next week. So we could be having a workshop Monday, and you might only find out Sunday. But come on out. You have nothing to lose. Worst comes to worst, you're going to say, Dave, you smell bad. I don't like you very much. And you wasted an hour and a half of your time. But it'll be fun. Sometimes I bring coffee. We have a lot of fun learning super fun accounting topics. The last slide's not working, but I did want to give you my contact information. My email, and I do respond to email because I just love accounting so much, is dbyrne, at connect.carleton.ca. So send me an email. I love to answer accounting questions. Otherwise, I will see you next week. And also check for the announcement on WebCT for when the workshops will be. And finally, I do have an office hour once a week as well. So you can come to my office hour, we can talk accounting, do some practice accounting, and just, talk about the wonderful world of accounting. Okay, thanks for listening. Hope to see you next week. I know how to get it.
Thanks a lot, Dave. That's great. So yeah, sometimes technology fails us. Huh?
Yeah. Oh, there it is.
There we go. Hi, CG. There, I'll just go through the rest of it. There you go. I will respond. Office hour. And that's the end of his presentation. Okay. All right. So before I actually get into the course material, I do have some announcements. Been peppered with questions the last week about people who've taken a course that was similar to this in a previous term. All right, so for a lot of you, you have no idea what I'm talking about. Those of you who started a minor in business last year might have taken Introduction to Financial Accounting or Business 1001. Okay. If you are registered in this course, you won't get credit for it, okay, because this course precludes credit for the other course. All right. So what you've got to do in order to finish your minor in business, okay, is to take both 1001 and 1002. That's one of the first requirements, right, in your minor in business. And how are you going to get into 1002? Okay, so what you can do is you have to complete a course override. Okay, so if I can just get my cursor, there we go. Minor in business students who have completed or passed Business 1001 prior to fall 2010 should take Business 1002 instead of this course, 1003. What you're going to have to do, please submit a registration override request in Carleton Central. Okay, so where am I getting this from? Let me just pan out here a little bit. This is the registration priority list, okay, for undergraduate business courses. This is on the Sprott School website. So who gets to register in each one of the courses and what's the priority? Okay, so let me scroll back down here. So I know it's awfully small there, but if you're just starting your minor in business, Business 1003 is the right spot for you. If you started your minor in business last year, okay, and you finished 1001, but you didn't get to finish 1002 for whatever reason, sometimes courses don't line up, then I suggest withdrawing from this course and registering in 1002 with this course registration override. Okay. that makes no sense to you whatsoever, all right, I urge you to go to the 7th floor of Dutton Tower. There's an academic advisor there who can talk to you about how to complete your minor in business. All right? There's 2 academic advisors that have all the scoop on this. All right? So I don't want people wasting their time. If you go to the course calendar, I don't know, it's awfully small here, but it says that this course precludes additional credit for Business 1001, 1002, 1004, 1005. So you will not get a credit for this course if you've taken 1001. Right? So I know Tufan was here last week, and he had been in 1001, and some other people also had asked questions about this, so this is why I looked into it. Now, there was a few questions. Yes?
So I'm just studying part-time, and I took 1001 last semester. I don't know how to consider it a minor, so that means I'm not eligible for credit.
Yeah, you won't get a credit for this one. Anybody who took 1001 and passed won't get credit for 1003. All right. Any other questions? Okay. All right. So, wanted to clear that up before we continue on further in the course. All right. Okay. See now. So, I've put some instructions on the WebCT for how to register for your online quizzes. So I'm using something called See Now. Why didn't that work? Only view. I don't know why it's doing that. Anyway, I put it on my WebCT. Why isn't it going? Oh, here we go. Well, I'm not going to get my WebCT then. Maybe I should just do a refresh on this page. Come on, I know my username and password. Anyway, I can't get onto it. All right. So posted on WebCT is a quick start guide, all right? And it looks like this. All right. So how to register for your CNOW account. All right. Every so often WebCT does that to me, and I don't know why. So with your textbook, you are given a course code. It's like an access code, all right? And that's your first step on how to register for your CNOW account, right? So to create your account, right, it's step by step here. Go to academic.cengage.com/login, right? And all of these instructions apparently are packaged into with your textbook on that card. There's a piece of paper, cardboard, with this code on it, and it takes you through the steps. But I'll just go through it once again. You have to click on Create My Account, enter the access code. That's step number 3. That's the access code you're given with your textbook, all right? Not the code that I'm providing, your specific access code. All right, so enter your account information. So it's going to ask you in part 4 here, what's your name and what university do you go to and that sort of thing. What's your email address? So press continue, read the license agreement, select I agree, and then enter your school name, okay, verify your information, and then it says the Cengage Now homepage opens. All right, so there we go. If your professor provided a course key, click Register for a Course, and that's the course key that I had posted here earlier. This is also on my WebCT. I have no idea why I can't access it, but copy and paste it in because it's quite very long, and anyway, copy and paste, all right? So, keep that up, okay. Yeah, that is on WebCT as well. It's too bad I just can't get it to work. And yeah, I've entered an incorrect name. That's just great. Anyway, that's also on WebCT, so you can go in there and check that out, how to get your CNOW account. Now, some of you have been successful. I've got about 6 people already registered, so they saw my announcement. It's right on the face page of WebCT, and they got in successfully. Maybe it'll work now. Anyway. I can just show you. So for those of you in first year, I mentioned this last week, I do use WebCT. Not all your instructors will, but I like to use it. Am I getting through? Finally getting through. All right. I do post my course slides here. If you missed last week as well, the course outline is here. All right, so it's on the main page of this course, WebCT. All the courses that you're registered for, I think they automatically prepare a web page for. So I will run this. Now it's working. You should get a whole list of courses that you're registered for. I get a list of courses I've taught and am teaching and scheduled to teach. And it's thinking. There we go. So click on Survey of Accounting. This is what it should look to you. It's taking a long time. So you see a course outline, click on that, get the course outline. I don't print them. I had a number of questions last week. Where's my copy? I don't print them. Right? Save an electronic copy of it too, because you just never know if somebody ever asks you, what did you study, or if you transfer or whatnot, you've got a record there of what the subjects were. The PowerPoint slides and as well the scanned pages of the problems that I take up. These sheets here, I PDF them, scan them PDF, and I put them here on WebCT. Right. The CNOW registration details, okay, is exactly that quick start guide. I've PDF'd it, put it in there. And the course key, this is what I'm trying to get to, is right there. Okay. Let me make that bigger. Video on demand access has been created. All right, so even if you're not a VOD subscriber, which costs a little bit of money, you can see the first lecture for free. Okay, just so you know. Got some extra time, you want to see me from last week, yet again, you can watch that. Again, if you want to subscribe, I think it's $40 some, $50, you get unlimited access to any lecture throughout the term. All right? And you have to arrange it with the CUTV people. Okay, and that's where you access that. All right? Discussions, I noticed there's discussions already. All right, so Dave created one for PASS, all right, and that's been put in there. That's for the CUTV folks, those of you watching on TV, to vote for your PASS time. So go into that thread and take a look at what times he's proposed and vote there if you're watching. All right. Any announcements I will post here? I've got nothing there. All right. And this is also a spot for you to see your grades. Although the only grade I'm going to post would be your midterm toward the end of October, beginning of November. All right. So that's WebCT. All right. And it's also got all my contact information. All right. So where am I and when? So that's CNOW registration. So the first CNOW quiz will open up next week on the 22nd. All right. And so on Thursday's lecture next week, I'm going to show you what it looks like, and we'll go through one of the reiterations of it. Okay? Because I also have the student view of CNOW, and I'll show you exactly the problems, the drop-down menus, how to navigate through it. Okay? You're going to be given actually a full 8 days, because it won't be due until the following Wednesday. Okay? So your first CNOW quiz is due on the 29th, I believe, at midnight. That is a Wednesday. All right, so every Wednesday you're going to have a CNOW quiz that is due. Let me just double check that. Make sure, yeah. So yeah, due September 29th, okay. Yeah, and it'll due Wednesday at midnight. You'll be given 9 quizzes, one every week, except the week of the midterm. I'll take your best 8 for your mark. All right, these are worth marks. Right? So just if you're new to the course. I've had a lot of people register in the last week or so. Okay, so we're at like 215 now, whereas last week we weren't. It keeps going up by quite a lot. So if you're new, take a look at WebCT. Review that course outline, okay? You'll get a lot of your questions will be answered there, all right? Textbook, everything else. All right. So I've mentioned CNOW, and we've gone through WebCT. All right. Any questions on the online quizzes or anything else so far? Great. Where am I? Let's review chapter 1. Okay, so last week I did start the course material. We did start chapter 1. We almost finished chapter 1. I had hoped to finish chapters 1 and 2, but anyway. Consider my course schedule like not sort of etched in stone, written in stone. It's flexible. I'll finish all those subjects eventually. Right? So chapter 1, just a bit of a refresh because we didn't get through all of it. We looked at financial statements, just what sort of information are they providing. And so we looked at the income statement, which answers the question, essentially, how well did we do? What's our performance like? Okay. And so we look at revenues and expenses. And so here's a scanned copy of the Hershey Company's income statement. All right? So their sales in millions, all of their expenses, the cost of their chocolate bars that they sold, some selling and admin expenses, interest, income tax. And look at that, they've got a net income of $311 million. Okay? So good for Hershey Company. Who is interested in this? Okay? Primarily, I have to say investors. They're really sensitive to income statement. Okay? And we looked at stakeholders and users of financial information. Investors, really interested here. I was watching Dragon's Den last night. Does anybody watch Dragon's Den? CBC? Yeah. Okay, so last night they had Hope Rocks. Okay, so this rock company, somebody came in dressed as a railroad engineer. I'm not quite sure why. Anyway, and he's got this land with all of these rocks on it. And so they were calculating really quickly. They were asking him, how much can you sell those rocks for? What are your expenses? What are your transportation costs? And they calculated, just on the spot, all of these dragons, what their net income was going to be. So investors, potential investors, very interested in income statement. All right. They also had another company made baby moccasins. Anybody watch this last night? It's just last night's episode. Yeah, the little baby moccasins, and she had a little baby and everything. And so they're really cute. And she's from just north of Gatineau here. She's a native lady. Anyway, it was really cute little baby moccasins, and they stay on the feet, which is really hard. Try to keep booties on babies' feet is really hard. And she had given them all the income statement information that they needed. All right. Then there was another guy. He had no income statement information. And so they were really disappointed with that, and they said, no, go away. We're not investing with you. I'm out. Okay, is how they put it. So it's a rather interesting series. If you get a chance, watch it, and they'll talk often about these income statement items, okay, sales, expenses. Okay. All right, so we're looking at how much money did they make, performance. Investors are interested in this, creditors to a certain extent, because they just want to know, their ability to generate profit and cash, if that follows. We also looked at the statement of retained earnings, which is generally the next financial statement that's prepared. Okay, so what is retained earnings? I think I wrote down a textbook definition even of this last time. It's that accumulation of net income since incorporation less dividends declared since incorporation. So for some companies, this can be quite hefty, all right? So think about, especially older companies, how much net income have they made over the years, and how much have they distributed to all of their shareholders in the forms of dividends, right? So what remains in the business? What is the earnings that are retained? Hence the term retained earnings, okay? So that's what we've got here. And how do we calculate it? Well, we look at the retained earnings statement, and it's rather simple. What was the beginning balance at the beginning of the year, the month, whatnot? Let's add net income and subtract out dividends to give us our current year's year-end balance. All right? It's simply that. And then the next statement we took a look at is the balance sheet, and that my slide is not formatted properly again. It's illustrating the accounting equation, which we are going to see repeatedly in this course. All right? Assets equals liabilities and equity. All right? So, all right. It didn't get formatted there, but that's essentially what it says. So on the one half of the balance sheet, we list assets. And on the other half, imagine these being two halves, we have liabilities and equity. Okay? And it's got to agree. So for Hershey here, they have $3,635 million in assets, and their liabilities and equity also totals that. Okay? So that's good. They've done their balance sheet correctly. Right? I urge you all, if you ever issue a financial balance sheet, make sure it balances. All right? That's the balancing part of it. All right? So essentially assets, things of economic benefit for a company, future use. Okay? Usually cash is listed first. We put it in liquidity order. So all these things that are of use to the company or can be converted to cash, they're financial resources. Okay? Cash, accounts receivable. Okay? Who owes us money? Because sometimes we issue invoices to our customers. We say, pay us later. Inventories. We can sell that. That's a good economic resource. Prepaid expenses. Well, we're going to get the benefit of that in a future period. Property, plant, and equipment. Think about all the assets that you own that are more longer term, right? Cars. Maybe somebody said they had a car here last week. Bicycles, computer equipment, right? Laptops. Tangibles are assets we can't touch. Right? And then we list the claims on these assets, okay, in the other half. So sometimes our creditors owe us money, and we call those liabilities. Our creditors, we owe our creditors money. Sometimes we owe suppliers money, we call that accounts payable. Sometimes we haven't received the invoice yet, we call that accrued liabilities. Notes, we're referring to promissory notes here. Income taxes payable, yes, it's a fact of life in this country, income taxes. So this is the creditor's claim on the assets, which actually I think is rather significant in relation to the total assets. Right? Then we've got the owner's claim on the assets, so all the shareholders, and that's what their equity is. So they've contributed capital stock. You know, they bought share certificates from the company. This company issued share certificates to the shareholders to the tune of $712 million. That's what that means. Their retained earnings, $3,976,000,000. That number is actually coming from the previous slide. $3,976,000,000. Okay, that is flowing in here. There you go. All right. And I'm not going to get into repurchased capital stock and other equity items, but there you go. So you've got assets and claims to the assets. So in the event that this company is ever wound up or is going bankrupt, okay, creditors get paid first. Okay, some of them secured, some of them not. All right, and then whatever's left goes back to the shareholders. Okay. And this book calls them stockholders. And there we go. A statement of cash flows, I'm not going to get into a lot of detail on. Okay. So we did not finish this problem, right? And I think I said, go do it, right? And, you know, that's going to be the big difference between high school and here, is I'm not going to make sure that you've done it, all right? So I'm relying on your ability to get organized and to work out these problems on your own time, to read the chapter too, all right? And I'm highly suggesting that you do the problem. Okay, it's going to be key to your learning. Do all the problems that I take up in class, but I'm not going to check, and I'm not going to allow time for us to do it in class, okay, where I pace up and down the aisles and make sure you do it, all right? So this is primarily, it's a lecture format. All right, so hopefully some of you did do this, all right? And I'm not even going to ask who did, who didn't. It's in your best interest to do it. The following financial data were adapted from the annual report of Best Buy for the period ending February 28, 2009. And these are items from many different parts of the annual report. The annual report also includes a set of financial statements. Okay, so what they're really saying is this is from a set of financial statements. So what do they want us to do? They want us to, first of all, prepare the income statement. And as we found out earlier, that's got to be the first one always, is prepare the income statement. Okay? Because the number on the income statement, that net income number, flows into the retained earnings statement. So that goes next. All right? And then lastly, prepare a balance sheet. Okay? So we are going to do them exactly in this order. But we're not given much guidance here. We're just given a whole listing of accounts. Okay? So it's up to us to figure out, okay, what is that income statement again? Oh, this is 1-3. So if you remember, I do like to have a nice heading. Okay, I do assign marks to that. And it had to take the form of name of the company, name of the statement, anyway. And what's next? Does anybody know? Date, yeah, in some form or another. But in this case, because we're dealing with an income statement, we need to know what time period. And they're not being really specific, for the period ending. Now, it is an annual report, so I'm going to assume it's for the year ending. And that's really what I am looking for whenever I prepare a marking key for an income statement, is somebody says here, for the year ending February 28, 2009. You will not get marks if you put here as at. Okay? An income statement is how much did these accounts grow by over the year? Okay? How much did they increase or decrease by? Right? For the year. It's not as at. Okay? All right. So what is generally first? Does anybody remember that from last week? Revenue, right. So let's go through the list here of accounts and figure out what is revenue. Accounts payable, that doesn't sound right. Actually, what statement does accounts payable go on? Maybe we'll start with that. What statements? The balance sheet, eh? Okay. I'm going to put B/S, but that means balance sheet. Okay. What statement does capital stock go on? The balance sheet again. Very good. Cash? Balance sheet, yeah. Cost of goods sold? Income statement, yeah, we saw that with Hershey, the cost of all of their chocolate bars sold. Right. Income tax expense, what's the statement? Income statement, yeah. So a lot of you are wondering, how do they know it so quickly? Okay. Go back to your definitions. Balance sheet has got assets, liabilities, and equity items. All right. So I'm looking at accounts payable, and I'm thinking, well, what does that mean again? Payable. That generally means we have to pay something, and I'm thinking, well, that's a liability. Liabilities belong on the balance sheet. Okay. Capital stock. We actually, if we just remember and get familiar with the balance sheet, I remember that that is part of equity. Okay. Stockholders' equity or shareholders' equity. Cash. Well, that meets the definition of an asset. Assets are reported on the balance sheet. Okay. What's reported on the income statement, as we already alluded to, revenues and expenses. There are two sections, essentially, for now. So anytime I see the word expense or an item that looks like, oh, that's an expense, like cost of goods sold, that goes on the income statement. Okay, so I see the word expense there. Okay, what else do I see? Oh, there we go. At the bottom, selling, general, and admin. See the word expense? I know that's income statement. It'll make my life easier. What statement does inventories go on then? Balance sheet. So we're holding it to, it's a future economic benefit there. Investments. Balance sheet. Another asset. Right. Goodwill and other intangible assets. Okay, so again, that's pretty obvious. All right, that's a balance sheet. Assets. Oh. I know assets are reported on the balance sheet. Liabilities, I also know that they are reported on the balance sheet. Okay. And I see the word revenue. Okay, so that's tipping me off. I know revenues go here on the income statement. Okay. Property, plant, and equipment. Balance sheet, yeah. We can use these assets in order to earn revenue, generate revenue. Receivables, what does that word mean again? Balance sheet. That means my customers owe me money. Okay. And I'm about to receive some cash, and that is an asset. Okay. Sales statement, income statement, yeah. Okay. So yeah, it looks like revenue there, revenue there. We've got expenses on the last one. So coming back to this, now that I've done all that, I know where it goes. Income statement, I know I report revenues and expenses, and I've identified two revenue type accounts here. Sales is one of them. And what was the other? Other revenue net. What does net mean? It means they've subtracted a number, some amount at some time, just to arrive at this one. And it's generally smaller, eh? There we go. At this point, I really don't care much about the format. All right, so yes, there were those of you who had taken high school accounting, which is fine. Yet if you haven't taken high school accounting, it's not a prerequisite for this course. But if you had taken it, you probably spent a lot of time on columns and lining things up and dollar signs and underlining, and I really don't care about that. Okay, just put the numbers down, please, so I can give you some marks. All right. All right. So what I've done here is I've just put a line to indicate I've done a calculation. I've added 7 to 45 billion and 15. Okay, and then I put the subtotal over here. You can do that or not. You can put it underneath too. I don't care. Just put the numbers down somewhere. All right, so we're going to go back to this list here and let me just figure out what were all of my expenses. So that was an expense. So we've identified all of those that are expense items on the income statement. Oh, no, that wasn't it. No, we're fine there. Okay, so it looks like I've got 4 expense items. Yeah, I've already recorded that one, and I've recorded that. So that was revenue. Oh, and I've got this other one, at the bottom. Yeah. All right. So for now, I'm going to group all my expenses together, but there will come a time when I won't. Anyway, that will be in another future chapter. Cost of goods sold, 34 million. This is 34 million. That's that's a huge expense when you consider their sales. But this is Best Buy. They are a merchandiser. Right? Merchandisers buy merchandise and then resell it. So that should be one of their larger expenses. Income tax expense, 674. They have interest. 94. Other expense, 250. Oh yeah, selling general and admin. This is obviously from an annual report, and this is really summarized. But in the real world, I can tell you, in an internal accounting system, there's going to be far more expense accounts than this. Okay, this chart of accounts is generally huge. It goes on for pages anyway at the companies that I work for. All right. So I put a line just meaning I'm doing a calculation, and the calculation I'm doing is I'm adding all the expenses. Okay, so I get 44 billion and 19 million. Right. So I think I've got just enough room here. The last line is net income. $1,003 million. There we go. Yeah, and I am putting double lines here and whatnot, but would you actually get marks for lines and dollar signs and lining things up? No. Just put down the account name and the amount, please. Yep. Put what in brackets? In millions. Oh, in millions, yeah. Yeah, have they specified that? Yeah, they have. I wouldn't specifically give marks for that, but yeah, it is important. You don't want to mislead people. It is in millions. So good point. Any other questions on my sloppy balance sheet? Okay, good. All right, so we did step 1 here for Best Buy. Right, their income statement, we've done. Then next is the retained earnings statement. So this is number 2, and retained earnings statement. As always, the name of the company. The name of the statement. Is it as at, or is it for the year ended? For the year ended, yeah. What we're doing here is we're accounting for the activity for a particular time period, so for the year ending. All right. This one is fairly simple. You know, there's not a lot to memorize in accounting, but format, certainly, of the statements is one of the things that you'll have to memorize. But you'll find the more of these statements that you do, the quicker that is, the easier it is to recall. Right? So what we need is the retained earnings balance at the beginning of the year. That is the first line. March, yeah. They've got it there. March 1st, 2008. So they've given us the retained earnings balance at March 1st, 2008 was $3,930,000. Oh yeah, in millions, right? Yeah, they've had to give us some extra information here for us to complete this. There's 2 items that we need to show here in order to get to the ending balance. What's one of them? Net income, right. And that comes from the statement that we just did. Okay, so we're going to add a $1,003 million. Okay. So if I go back here to my income statement, this last number, 1 billion, 3 million, that goes here. That's why we do them in this order. Okay? Because one integrates with the other. Right? What's the other item we need? Dividends, right? And look at that, it's right there. 222. And that will give us our new balance in retained earnings. So, 4,714,000,000. Yeah. Simply that. Yes?
If it's net income, and if we get a net loss in net income, do we subtract it from the retained earnings?
Yeah. It's a good question. Is it Naomi? Cynthia. You were sitting next to Naomi last week. Okay. All right, so Cynthia's got a good question there. If they had a net loss, do we subtract it? And yes, that's what we would do. All right. So this would be something to subtract. And obviously net losses are going to eat up your retained earnings balance. Okay, so not bad to have a net loss in some years. You know, you eat into your retained earnings balance. It's like a surplus. Retained earnings is really the surplus that you're retaining. And you can do that, but you don't want to use up your entire surplus or retained earnings balance. Okay. Yeah, but that would have the effect of doing that. Okay. All right, we'll continue on. Number 3 was prepare a balance sheet. Okay. So, name of the company, Best Buy Inc., name of the statement. Now, another question. Is it for the year ended or is it as at? As at. Yeah, balance sheet is like this. Somebody took a camera and took a picture. What is the state of affairs or what's the financial position today? End of business. Okay. So that's why it's very important here to say as at. Is it February 28th, 2009? They got it as of. You know, you can put as of. Yes, that's fine. Okay. Oh, good. All my marks remained. For now, for this chapter, we are just going to list assets and then list liabilities and shareholders' equity. Okay, after that. There will come a chapter when it won't look exactly like this. We'll change some of these headings up a bit. This is how it looks for now. Generally, we record our assets in liquidity order, meaning how quickly can we convert this to cash. Here's the cash. So, first up, obviously, would be cash. Okay. So, where is that? There it is. 498. Oh. Now, sometimes it's hard to tell for this particular business what would be the next item that can be converted to cash, you know, in that order. But generally, receivables go next. $1,868,000,000. Investments, it's hard to tell. Like, we don't know the liquidity of some of these assets, but anyway. So I'm going to put investments next. You know, it gets a bit foggy, eh? Are these investments, are they all GICs that are going to be maturing next month? Right? Are they 30-day term deposit sort of thing? What else was an asset here? After this, it gets hard to tell. Inventories, that's another one. Quite significant for Best Buy because they are a merchandiser. It's another asset. Well, I see the word asset in some of these. Goodwill and other. And what else was an asset? Property, plant, and equipment. 4,174,000,000. Is that it? I think so, eh? These other items belong in other spots, I guess, of the balance sheet. All right. Make sure I'm adding that up right. I always have to do it twice because my calculator has been known to fail. Four, seven. All right, I think that's what I am getting. Right. And what's the other half of the balance sheet? Liabilities and shareholders' equity. Okay, so we list what's of future economic benefit, what can we use here in order to generate revenues, what's to the good, and then who's got claim to those things. Okay. So we're going to start with our creditors. What is the first creditor type account here? Accounts payable. There you go. And again, we generally list these in the order that they're due. Okay, so we generally pay our creditors, our suppliers, in accounts payable. We try within 30 days. Capital stock belongs elsewhere. What's left? Other liabilities. There we go. And the other part of the balance sheet is what are the owner's claims on the assets, shareholders' equity. Okay, so in the event that this company is ever wound down, the suppliers here are going to get a stake on the assets, and then whatever's left goes to the shareholders. So capital stock is generally one of the accounts that we list there. Am I missing something? Retained earnings, that's right. Okay. So that's one of the statements that we prepared right before this one. Let me just flash that. We're going to take this retained earnings balance now and put that into the balance sheet. Okay, so all these statements are integrated that way. Yeah, and I thought that was happening. Now, unfortunately, it doesn't balance. And I can tell you why. I'm looking at the answer key here as I do it. And for whatever reason, there seems to be a typo in the book. Okay, inventories, according to the answer key, should have a balance at this 4753. Okay, so instead of it being 4573, the answer key says, no, that's really 4753. And that would make my balance sheet balanced. Okay. So I had started this just looking at the numbers from the textbook, the way it's published. But really, there appears to be a typo in the textbook. Well, that's going to change things. Minus 4573. Oh, that's better. So now I've got total assets, 15,826,000,000. Okay. And that does equal my liabilities and shareholders' equity. Okay. So the second page here of my balance sheet, 15 billion. $826 million. I'll just put equity. Running out of space. Okay. It's always important to have your balance sheet balanced, by the way. So I've got two other jobs besides this one. And so usually what I do the first week of every month is I work on making sure all the entries are in the accounting system, that I've got bookkeepers that enter in revenue and that sort of thing, and expenses. And then I do other things to prepare the financial statements. I do a review basically of all the accounts to make sure I've captured everything. And the first the set of financial statements I prepare is the balance sheet. And I would never issue a balance sheet that doesn't balance, by the way. So it's part of my regular reporting to usually board of directors or executive and finance committees. All right? So I send that out. So last week I sent out my balance sheet. That's always the first thing I look at. Does it balance? Because that would be really embarrassing as an accountant to issue a balance sheet that doesn't balance. All right. So this one does, now that we've rectified the typo problem. All right. So that's good. Any questions on that whole process? We're good? All right. Okay, so who actually had done the problem before coming to class? Oh, good. All right. So yes, it's the beginning of term, okay? And we always have these great intentions. I know I did as an undergraduate all the time. So those of you who've come back second, third, and fourth year, and I know I've got a lot, we make this promise to ourselves, right? At the beginning of every term, I'm going to stay on top of everything. I'm going to do my readings. I'm going to do the work that's required. And I'm not going to get to mid-October, the end of October, and feel overwhelmed and, oh, my goodness. And we try not to procrastinate, so that's good. Okay, keep it up, all right? Good for you. All right. But you notice I don't check that you have done it. Okay, do it because this is part of the learning of accounting, all right? All right, and we had finished chapter 1 otherwise. We just hadn't done that problem. No. All right, where am I now? Basic accounting concepts. That's what I want to get to. All right. So I'd hoped to finish this last week, but I didn't even start it. I will finish it today, and I'll hopefully get on to chapter 3. So these are building blocks. I've got a little graphic there, the ABC blocks. All right, so consider chapter 1 like that B block there. It's on the bottom. Right? You need to understand the material from chapter 1 to advance to chapter 2. All right, so if you haven't done so already and you're not entirely sure of this material, read the chapter at least and redo that problem. Okay? Don't just watch me do it, because what you're going to find is that it's really easy to watch me do it. And yes, yeah, that looks great, Patty. You've done a great job. But in order to truly understand the concepts, actually do it. Right. So we're building on our financial statement framework, as it were. Okay. And we are going to now describe the elements of a financial accounting system. Okay, so what does this mean? Well, it's that process of getting all of the transactions, all these changes in the accounting equation into a system somewhere so that we can do some reporting. Right? And I have to say that is like the fundamental part of my job, is that financial accounting system. Right? So each of my jobs, we have a financial accounting system, a way of capturing all of this data. So anytime there's a transaction, a change, we capture it. And we capture it correctly. We capture all of them, and we don't make mistakes doing it. Okay? And then what I do follows from that. So if this isn't right, if the financial accounting system isn't right, then a lot of the other stuff that I do will also be not right. All right? So what else do I do? So once I've got this financial accounting system, I do such things as forecast cash. That's a big part of my job every day. I forecast cash. Do we have enough cash to pay employees? Right? So imagine you're working for a place and they don't have enough cash for your paycheck. They're not going to be around. So I want to make sure we've got enough for the payroll, we've got enough for the suppliers, what's coming in the future, what's coming out. And I rely on the financial accounting system to do that. Okay? I use this financial accounting system for reporting. So the reports that we just seen, I prepare those. But I'm also comparing them to something called a budget, and I'm forecasting. Where are we going to end the year? I get asked that question a lot. Okay? But I need a good financial accounting system in order to do that. Okay? I'm going to use the information in the system to actually calculate cost information. So how much does it cost to publish this scientific journal? That's in one of my jobs. Okay? So how much resources does it actually take to publish the Canadian Journal of Animal Science? Okay, so that's one of the things I use my financial accounting system for. I'm also going to be using that to make decisions. Okay, should we make or buy, certain items? Okay, should we publish the journal in-house or should we send it out for publishing? Okay, so we need information from this financial accounting system. Okay. Contracts and purchasing, I spend a lot of time doing that too. Is this contract that's in our favor? How should we write this? Right? So I need, again, more information from the financial accounting system to do that. Should we drop this line? I get asked that a lot. Should we continue to do this sort of activity? Is it profitable? Or in the case of a nonprofit, is it breaking even? All right? I need a financial accounting system to tell me that information. Right? So this financial accounting system, the basis for a lot of what I do. Okay? Awful lot of what I do. So we are going to look at analyzing, recording, summarizing transactions for a company's first period of operations, and then prepare their financial statements. I know there are other objectives here, and they had to do with second year of operations, and I couldn't understand why. Okay, objective 4 and 5 had to do with analyzing, recording, summarizing transactions for the second year, and essentially that's the same as the first year, so I'm not quite sure why they had that in there. So we're just going to be looking at a period of operations, all right, in our review of this chapter. Okay, so what is a financial accounting system? Well, we produce financial statements out of it. Generally, they're computerized accounting systems. Right? So something like Simply Accounting, an ACPAC. Mind Your Own Business, that's another one. It's the name of a package, MYOV. And there's also large ones too, SAP, Oracle, huge accounting systems. And at the end of the day, they'll all do the same thing. The functionality is you're going to produce financial statements out of this. Okay? So what we just did, the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows, which I am not covering a lot here. And the system also determines what transactions are we going to capture, okay, when are we going to capture it, and what amount should be recorded. Okay? And that's all that an accounting system does. Okay? So for this part of the lecture, I actually need 3 volunteers to come up to the front and be my bean counters. What beans? Accountants are often told that we're bean counters, that we're concerned with the quantification of transactions above all else. But if I could have 3 volunteers to help me count beans and distribute beans. Come on. It's easy. Okay, well, come down. There's 3 there right in the middle. Fantastic. So I'm going to have one of them be the business owner. Okay, and the business owner has started his business with a certain amount of beans, and I can tell you that there are 15 beans here. And I'm going to have another person be a banker, and they're going to get 5 beans. All right. All right, so you want to be the business owner? Sure. All right, so what's your name?
Nigel.
Nigel. Nigel is my business owner. He's starting his business here with 15 beans. And then I got a banker. What's your name?
Peter.
Peter is the banker. Okay. And Jill is your customer. Okay. All right, so come over here, business owner, Nigel. Okay, so here's your, this is your business. Okay, so you are starting off business. And you can't just start off business, with 15 beans. You're going to need, some equipment and whatnot. But before Nigel can get his equipment, he needs to go to the bank. He needs some extra cash. So would you kindly give him 5 beans? Okay. All right. So now he's got 20 beans. That's great. Okay. So now you can go and buy some equipment for your business. Okay. So for your equipment, I'm going to need 10 beans. Yeah. All right. So yeah, we are bean counting. I know. Accountants have got this bad rap. Yeah, they're bean counters. So you can't just start business with nothing. Okay, you need something. All right. So I make sure I'm not going to be gypped here. I got 2, 4, 6, 8, 10. Thank you very much. Okay. So now he's got some equipment. There's some imaginary equipment here. All right. And so now you're ready to open up shop a little bit. So you got a customer. Okay, so Jill is going to give you a sale. She's going to give you 3 beans here. All right. So that's good because you were really getting low on beans there. All right. Okay, but unfortunately, you have to pay the bank some interest. Bank loans don't come interest-free. All right. So go back to the banker here. He's going to want, what do you think, 4 beans? Yeah, 4 beans. All right, so interest at 4 beans. So give your banker some more beans. Oh no, he's losing more beans again? This is what happens in a business. You look at your bank account and suddenly it's dry and you're like, what happened? All right, so you're really down there, aren't you? Okay, so you're going to need another sale. So, okay, Jill, 2 beans this time for the sale. Okay, so we got some beans. All right, now you're going to need some supplies. You really had none to start with. All you've had is some equipment. So I'm going to need 5 beans for that. All right, so we got some beans here. All right, you have employees, by the way, and they'd love to be paid. So, let's put a pot here for the employees. They would like to have 5 beans. Yeah. Oh my goodness, he's running out of beans. Okay, Jill, he needs a sale. So, how many beans do you have left there? Oh, give him 1. Just give him 1. There we go. All right. And what else? Pay some more interest to the banker. 2 more beans. Oh no, it's all gone. Okay, so in a financial accounting system, okay, the questions we would ask now are, how much were your expenses? See, we need to keep track of this. How much did you pay in interest? 6 beans, yeah. See, what a system does is it keeps track of all of this. How much were the sales? Does anybody know how much were the sales? 7, 4, I forget even. But this is where a financial accounting system comes in really, really handy, okay? And what was the cost of your equipment again?
5? No.
It was 10. Yeah, it was 10. So we need a financial accounting system really badly. We don't know the cost of our equipment, all right? And how much was the bank loan? It was 10, yeah. Again, we have this need for a financial accounting system. These are really pertinent questions that business owners, okay, investors, suppliers, customers, they all ask these questions, even the employees. How much money did we make? What was your net income? We need a financial accounting system. I'm not putting you on the spot. We realize we have this need, okay, and that's what the financial accounting system does. It answers all of these questions, all right? So thank you very much, business owner, banker, and customer. All right. And give them a clap. They did a great job. Yes. Good job. All right. All right, so hopefully now we can see what the aim is of our financial accounting system. Yes, we want to produce financial statements, but the only way we're going to do that is if we keep track of the transactions that we're recording. So the system determines the what, the when, the amount, okay, that should be actually recorded. All right. So what are we going to model our financial accounting system on? We're going to model it on the accounting equation. Okay. So remember, this goes back to the balance sheet. The balance sheet shows and demonstrates the accounting equation, but all of our financial accounting system, our transactional analysis, is going to go back to this equation. All right? And it wasn't that long ago for you, but in some point, in some math class leading up to this course, to university, we were told just basics about an equation, any equation, that if we are going to change one of the things, okay, in the equation, that it must remain in balance. One side must equal the other afterward, after we make the change. So if assets increase, okay, on the other side, one of these others has got to increase. Maybe a liability went up, okay, maybe equity went up. If assets have decreased, well, the other side of the equation must also decrease. Okay, so maybe equity has decreased. Okay. It could be in a certain transaction, assets go up, but then another asset account also goes down. Okay. So this goes back, I don't know when it is, but I know at some point you have been told this about an equation. Okay, so if we are going to change it in any way, okay, if assets are going to increase or decrease, after that change has happened, the accounting equation must also, the equation must agree, balance, okay, as it were, right? So the only way that's going to happen, if one side goes up, the other side must also go up. That's a possibility. One side goes up, maybe there's also a corresponding decrease. One side goes down, the other side could also go down, okay, and that makes our equation continue to balance, okay? So the accounting equation must remain in balance after each transaction, okay? And every transaction, what we're going to find, affects at least 2 accounts, sometimes more, all right? So we might have cash going up, liabilities going down, okay, maybe another asset account going up, whatever. But the net effect is the net increase or decrease on one side equals the net increase or decrease on the other side. Okay. That's the way it's got to be. All right. So that's about the most complicated math thing. Does everybody understand, you know, the rules of an equation? Okay. You've taken enough math to realize that? All right. Good. So what we're going to do is expand the accounting equation, all right? And we're going to analyze our transactions this way, all right? So assets equals liabilities plus shareholders' equity. And the way we're expanding it here is we're breaking out shareholders' equity into two parts, okay? So we've got the capital stock, the amount received whenever we issue our shiny new share certificates. And we also have an account called retained earnings. And this just follows from what we know in Chapter 1. Right? We also know a little bit about retained earnings, that it is actually the beginning balance in retained earnings. There's one of my short forms. I will call retained earnings R/E. Okay? And that equals net income minus the dividends for the year. Okay? I'm going to expand it even more. What is net income? Sales minus expenses. So, if we make a sale, how is that affecting retained earnings then? Is it going up or down? If we make a sale, it's going up, right? Because we know that sales increase net income, okay? Net income increases retained earnings, right? Retained earnings increases shareholders' equity. It all goes in turn that way. Oh, losing the ink in that one. I'm going to expand this slide just a little bit more. I know that retained earnings is affected by sales and expenses. Okay? So let me just recap what we just last decided. If sales goes up, okay, so if we have an increase in sales, that increases retained earnings, which increases shareholders' equity. Okay. If I have an expense, okay, what does that do to retained earnings? It decreases. Right. Expenses decrease net income, okay, which has the effect of decreasing retained earnings, which has the effect of decreasing equity. What's the other one there? Dividends. Okay. Okay, so two components to retained earnings, dividends and net income, sales less expenses. Okay. If sales go up, okay, we make a sale, retained earnings goes up, equity goes up. We incur an expense that decreases net income, which decreases retained earnings, which decreases equity. If we declare a dividend, how will that affect retained earnings? Decrease. Yeah. So we saw, what did we just do? In Best Buy, they had dividends, they told us, of $222 million. And actually, we can see that on the statement of retained earnings. It decreased retained earnings. And that will, in turn, decrease equity. Okay. So I'm expanding the accounting equation just a little bit, and this will help us in our transactional analysis here. Okay. So, yeah, this exercise is just to demonstrate the accounting equation. Right. The Walt Disney Company had the following assets and liabilities in millions as of September 29th, 2007. Okay. So, I know my accounting equation. It's about the most complicated equation I have to memorize in this class. And they're telling me that assets are 60, this is billion, 928 million. And they filled in the other blank for liabilities. Okay? So that's what we know to begin with. So first question, determine the stockholders' equity of Walt Disney as of September 29th, 2007. So they're asking, what is the equity here? So, well, I know how to work an equation, right? Let's hope we remember how to do that. If I subtract then 30,175 There we go. I get what the shareholders' equity or stockholders' equity should be. Okay. So it's like fill in the blank. And I know that you have taken a math course. You must have taken a math course in order to solve for something like that. Okay. Okay. If assets increased by 1,569,000, okay, so what are we doing? We are increasing this side, so that was A. In B, they are proposing that assets increase by 1,569,000,000, and stockholders' equity increased by 1,570,000,000. What was the increase or decrease in liabilities for the year ending September 27th, 2008? It had to go down one, right? Because even the changes have the net effect on each side have got to agree. Okay, so this would have to be a decrease. -1. Yeah, that was wrong. Let me just put -1. There we go. I'm not introducing brackets just yet. So that would have to go down by 1. Okay, and let's just test that. Does that actually work? Will my accounting equation remain in balance afterward? Well, I hope so. Does this agree? 32, 323. Now, does that agree if I add them across? Yes. Okay. So this is true. The next question, what were the total assets, liabilities, and stockholders' equity? I think we've answered that. Yes. Okay. Based upon your answer to C, does the accounting equation balance? Yeah, we did a fairly good job there. Okay. So that's just illustrating the rules of equations, essentially, which I hope you can all recall. All right. So I think this is a good time for a break. I've got 5 to 10, so if we could come back in 15 minutes, 10 after 10, go get a coffee. It's been bright early morning. I'll see you in 15 minutes. All right, I'll ask you to bring your conversations to a close then, please. And you're all coming back? This is good. It's in your best interest to attend class, by the way, and to come back after breaks. Let's put it that way. So that's great. I will finish this chapter today, and I will start chapter 3, I promise. Okay, so I've laid the groundwork out. We know what financial statements are, how to prepare them, what's on them. Okay, and we've talked about the accounting equation, and now we've expanded the accounting equation, and we've looked at how transactions or changes in the accounting equation, how that plays out. So we last looked here at Walt Disney, their financial statements, where they were at the beginning of the year, how assets had gone up, so had equity. Therefore, what is the effect on liabilities? We understand how all this works, and we calculated year-end balances. Okay, and that's exactly how transactions work. You know, if you're going to have one side go up, the other side should also go up by the same amount. If one side goes down, perhaps the other side has gone down. Maybe what we've had is assets also go down. But let's take a look at that in action, all right? And so that's what this series of slides now will demonstrate. Okay, so transactions, what is a transaction? It's a change. Something in the accounting equation has changed, all right? So we're going to analyze that. So our first transaction that we're looking at, and I'm going to go back to that lemonade stand again. I introduced Julianne's lemonade stand last week. You know, the users of financial information for Julianne's lemonade stand. So that is one of my daughters, and she did have a lemonade stand over the summer. And so I'm going to make up some transactions here for her. All right. So transaction number 1, Mom invests $100 in the new lemonade stand. No, I did not, but anyway, let's just say that Mom invests $100 in our new lemonade stand. And we're going to make Mom a shareholder, okay? Meaning we're going to give her a share certificate, okay? So I think I doctored one up last week as well. And so that means is Mom is now an owner, okay? She's got a share. Yeah. And so actually we're going to give her 10 shiny new share certificates for the cash that she's putting into this business, right? So I've got the accounting equation laid out here. Okay, so there it is. And everything we do, we're going to relate back to the accounting equation, right? So A stands for assets, L liabilities, E is shareholders' equity. And so if the company now is receiving $100 in cash and issuing share certificates, how does that affect the accounting equation? Well, we know that cash is an asset. Okay? This company, this lemonade stand, has received some cash. Therefore, assets have increased, right? Cash going up by $100. Right? So one side of the accounting equation going up. So we can't just have this happen in isolation. We want the accounting equation to balance. So something else has got to have changed. At least one other account, one other element of the accounting equation has to have changed. Right? So if our lemonade stand is issuing shiny new share certificates, right? So if you can imagine, you are now a shareholder of Julianne's lemonade stand. And I issue 10 of these, right? And I now have an owner. It means my shareholders' equity has gone up. Okay, that capital stock account. Remember we broke this down? One of the equity accounts is capital stock. We saw that on the balance sheet, right? So the business has issued share certificates. We now have our first owner. Capital stock has increased. Okay, so anytime a company issues a share, okay, a brand new share, gives it to a new shareholder, we have issued capital stock. The capital stock account goes up. Okay. So this side of the accounting equation, therefore, has also gone up. And we see that, okay, assets have gone up. The other side of the accounting equation has also gone up by the same amount. Right? So we know that we're done our analysis, essentially. Okay? Both sides are going up by the same amount. Great. Okay? We are done our transactional analysis. So if we were to take a look now at the snapshot of this business, things have changed somewhat. Okay. So I now have cash, which is an account here under assets. It's gone up by $100. And I have capital stock. That's an account here under equity. That's gone up $100. What I can do at any point in time is just take a snapshot of it. If I wanted to prepare a balance sheet, I would now show cash of $100 and capital stock of $100. Okay. So that's one transaction, and it's changed things. We had nothing before. Now we've got something. Okay. Next transaction. Okay. The next day, Julianne's ready to open up her lemonade stand, and she's like, oh, I need to get some equipment. I still don't have enough money to buy the equipment. I need some cash here. So she went to the bank. We'll just pretend she did. She didn't actually, because she's only 11 years old, but anyway. So we still need more cash to start our business. Our bank lends us $200. Right? So what has happened now to the business? Assets have gone up. Cash has increased. Right? Because what the bank did is they issued a check or gave you cash, maybe, I doubt it, $200. Right? So Julianne's lemonade stand has now got an additional $200. Except now we also owe this money to the bank, right? We've probably signed a note, a promissory note. Our liabilities have increased. So on the other side of the accounting equation here, the bank loan is going up by $200. Okay? So again, things have changed. If we were to take a look now at what effect has this had on our accounting equation and our balance sheet, cash is going up, and now we've got this bank loan. It does say bank, anyway. That's going up by $200. And if we were to take a snapshot now at the end of business here, I've got cash of $300, bank loan of $100, and capital stock of $100. Okay? I'm just keeping a running balance here of what are my new balances. Okay? I just want to know, okay, this has happened, now what? Where do we stand? Okay? So on the one side of the accounting equation, under assets, I've got cash, $300. On the other side, I've got a bank loan of $200, capital stock of $100. I know I've done my analysis because both sides of the equation have gone up by the same amount. Okay, I'm in balance. Okay. Great. Next step. Well, now I've got enough money, I can go buy some equipment. Okay, so Julianne goes out, buys some lemonade making equipment. She needs, you know, one of these little coolers, some glasses, some spoons, whatever she needs, the table, a sign, whatever she needs. She goes out and she buys $150 worth of equipment. Okay, so what has happened now to the accounting equation? We know the cash has definitely been used up, okay? And that's going to be the most obvious part of all of this analysis, is that, oh, cash has been affected somehow. Okay, and it's really easy to identify. Cash is going down. But at the same time here, on the asset side of things, equipment is going up. Right? We've got our little fancy cooler, our table, maybe a little cash box, and spoons, some cups and whatnot. So equipment is also going up. So the net effect of plus 150, subtract 150, minus 150 is 0. Right? So the net effect on the asset side of the equation is 0. Okay? And liabilities and equity have not been affected. Okay? So net effect there is 0, which is okay. You can have a transaction that does this. Okay? No problem at all. Now if we were to take a look at what's the financial position here after this has taken effect, my equipment's gone up, my cash has gone down. So what are my new balances? 150 in cash, 150 in equipment, $200 bank loan, $100 capital stock. Okay, what happens next? Well, Julianne also needed some supplies. Okay, so in this case here, she went and bought those frozen concentrate things, the lemonade. You know, you add water to them, and you know, those are her lemonade making supplies. And she bought it on account actually from the supplier, okay, meaning she didn't pay the supplier right away. Okay, so this is our first transaction. There's no cash. Okay? So if you don't pay your supplier right away, you now have a liability, right? And we call that liability accounts payable. Okay, so accounts payable is going up $125. Now these supplies, they're a future economic benefit, right? Sort of meet the definition, I'd say, of an asset. Right? We're going to make money with it now. We haven't used them up either. So they're going to stay on our balance sheet, on our financial accounting system here as an asset until we actually use it up. So let's take a look here. How have things changed? Well, I've got a new account now under assets, supplies, and that went up by 125. I have a new liability, accounts payable, which, yes, I am making a short form, A/P, for accounts payable. Okay, so where do I stand now? 150 in cash, 150 in equipment, $125 in supplies, and my bank loan is still at 200. Accounts payable now, 125, and capital stock is 100. Okay, so things have changed. These are my new balances. If I'm going to do a balance sheet, that's what I'd show. Okay. And I know I've done my transactional analysis correctly because both sides going up by 125, and that fits the rules here for an equation. Next transaction. Finally made my first sale. So she's got her equipment, she's got enough cash in the bank, she's got her supplies ready to put that table out and sell some lemonade. She sells 20 glasses of lemonade, $1 a piece, $20. She's very proud of herself. All right, so again, it's quite obvious whenever cash is being affected, okay, the assets are going up. Okay, it's easy to identify the cash aspect of things. Not so easy to figure out what's going on the other side. Okay, so what's the other part of this analysis? We really have to take a look at, and I'm going to go back to this piece of paper, my expanded accounting equation. Right? So remember in equity, we divided it up. Shareholders' equity's got a capital stock component, retained earnings component. Retained earnings is really net income and dividends. Okay, it's got those two components. Net income has got two components, sales and expenses. Therefore, if we make a sale, like Julianne just did in her lemonade stand, remember we said sales has the effect of increasing retained earnings, increasing net income, and that's got the effect of increasing equity. Okay? So that's why I put my positive there. Sales increase this side of the accounting equation. Okay? And that's exactly what's going on here. Okay, retained earnings is going up because revenue is recognized. Okay. So when we have a sale, it's going to increase shareholders' equity. Okay. So that's my transactional analysis. Cash is going up, equity is going up. So in this case, cash, we're going to add 20. Retained earnings has now gone up by 20. I can also do another snapshot here. We've got $170 now in cash, $150 in equipment, $125 in supplies. There we go. And now I've got $20 in retained earnings. See, this is just my financial accounting system in action. It's giving me the update. I compare financial statements now. Okay. All right. Next transaction. Oh. So she had one of her sisters work for her, and she demanded $1. All right. So she paid employees wages for the week, and paid advertising as well, $15. Okay. Send out some flyers. Let's just pretend. So easy to identify here the cash aspect. You see the word paid. Okay. And we paid $1 for wages, $15 for advertising. That's $16 in total. Cash is going down $16. Yeah, I can see that. That's easy to see. Not so easy how to figure out expenses, okay, and how they are affected here. How is the accounting equation affected for expenses? So again, I'm going to go back to my expanded accounting equation. Okay. And recall that before the break, we said if we pay an expense, it's got the effect of reducing net income, okay, reduce retained earnings, reduce equity. And that's why we put here it's negative. Okay? Expenses have the effect of reducing equity, okay, with all of these relationships that are demonstrated here. Okay? Incur an expense, you reduce equity. So if Julianne pays wages of $1, advertising of $15, these are expenses. Okay? It has the effect of reducing, there's a minus sign that's missing, equity. Okay? So on the other side of the accounting equation, we get a total here of negative 16. So assets have gone down $16, equity has gone down $16. Great. And I've run out of room to post it, but we'll get to it. Then last transaction. Mom, put $100 into this business. And it's always really nice to give your shareholders a portion of the net income. Not all of the net income, but a portion. Okay? So every company's got their own dividend policy as to when and how much. Some companies never declare dividends whatsoever. Okay? But in this case, Julianne declared a dividend, gave Mom $2. As a dividend. And again, it's really easy to see what's going on with cash. It's going down $2, so assets going down $2. We also know here from our expanded accounting equation that if we declare a dividend, pay a dividend, and declare and pay, that dividends have the effect of reducing retained earnings, which reduces equity, okay, shareholders' equity. And that's why earlier on we put negative here. Dividends reduce this side of the accounting equation. So on that side of the accounting equation, under shareholders' equity, you see negative 2. Both sides go down by $2. Okay? Makes for a happy shareholder. Imagine that. A lot of shareholders look at that too. Mom got $2 on a $100 investment. What's the dividend yield? 2%. That's pretty good. Just in a month. This has just been 1 month. That's really good. All right, so there is a summary here. I started one here when I was making balance updates each time. But we can also look at it this way, just do one balance at the end of the month. Okay? And unfortunately, I can't seem to get rid of this thing here that's in the way. I don't know what software you're using, but transaction 1, I should say. Okay, that's where cash went up by 100, capital stock went up by 100. And what I've done under each of the, my accounting equation here, is I've created little sub-accounts, as I had done earlier. We know that cash is an asset and capital stock belongs under shareholders' equity. Okay. And I went through and I summarized, every time this happened, every time a transaction occurred, what was the effect here. And I've just continued what I was doing here, except I only make one balance at the end of the month. And so what I've got here is cash has got a balance of 152, supplies 125, and equipment 150. And if we've done everything correctly, I don't know why that doesn't always appear, our total assets, right, should equal liabilities and equity. I guess that's only if there's no typos. So I get total assets of 427. Right? I took all of those balances and put them together. Then I can add up the other side. Do the same thing. All right. So total liabilities and equity equals 427 as well. That is a 7. All right. So I must have done all my analysis correctly because my assets still equal my liabilities and equity. So that's good. I've done a good job doing my analysis and keeping my financial accounting system true, in balance. It's important to do. Now, this analysis in this slide is also really useful in preparing financial statements. Okay? Because if I'm to prepare my income statement and my balance sheet, statement of retained earnings, etc., I can just look at the activity on this schedule. So if I am going to do my whole set, I'm going to start with my income statement. Right? An income statement, we know, net income. I'm using some short forms here. Income statement is concerned with net income, right? And we know that net income items flow through retained earnings. So if I want to prepare an income statement, I'm going to look at this column here, this entire column, and all of what's going on, to account for net income. Also in this column, of course, is dividends, which I know that this is dividends. So that will certainly help. Okay? So I start with my income statement. I know to go to the retained earnings column and identify those that had something to do with net income. Okay, so it was my sale and it was my expenses. And my statement of retained earnings, again, I know to go to my column for retained earnings. Okay. I now am able to I know my net income. Okay, it's those two items. I know my dividends. It's that item. I prepare that. And then I can prepare my balance sheet. Okay, and that'll be my last step. And my balance sheet, I'll be looking at all of these balances here. Right? Where did we end up? All right, so this just reiterates here what I had on this piece of paper. We expand the accounting equation. Okay, we know that stockholders' equity is capital stock and retained earnings. I think we've got that. Expenses decrease retained earnings, dividend decrease retained earnings, whereas revenues increase retained earnings. And so does capital stock increases stockholders' equity. All right, so I am now able to prepare my whole slew of financial statements. Okay, I know that I had to go, in order to prepare my income statement, I need to go to the shareholders' equity accounts, okay, under retained earnings, and identify the items here that pertain to the income statement. Okay. So I had my sale and I had my expenses that I paid. Okay. So I'm taking the $20 and the $16. There we go. So there's the $20 coming in to my income statement and the 16, which was actually the wages and the advertising. Okay, so that's all being pulled out of my summary sheet there. Okay, looking under retained earnings, identifying those that pertain to the income statement. Okay. So did I make money this month? Yes. Julianne's Lemonade Stand made money, $4 of net income. I can now prepare my retained earnings statement. Okay. Julianne just started up her lemonade stand. So the retained earnings balance at the beginning of the month was 0. Her net income we're pulling from the income statement. Dividends, we're pulling from that summary sheet under the retained earnings column. We found that dividend of $2 that we gave to Mom. I am now able to prepare my balance sheet. So what I'm going to do here is list all my assets. I'm going to pull the balances from the cash account, the supplies account, equipment account. Okay. Where did I get that? I'm going back. There we go. So I'm ready to prepare my balance sheet now. I go under my asset accounts and I pull cash, 152, supplies, 125, equipment, 150. Okay? That's where I got those three amounts. And I'll flip to it again there, the balance sheet. We've got accounts payable will be listed next, 125, bank loan, 200. Okay. And we're also going to pull the capital stock, 100. Okay, so that's where I get the 152, 125, 150, my liabilities, and my capital stock. Where did I get this balance of $2? That wasn't on the... Where was it? It was from the last statement. You can get it from here. Actually, I updated retained earnings as I went along. So that's where that goes. All right, so that is my new and improved balance sheet, September 30th. Any questions so far? All good? All right. I forgot to label this problem, but it is P2-1. Okay, so I like to take problems from the textbook. Okay, and take them up in class. So Chris Woods established an insurance agency on July 1st, 2011, and completed the following transactions during July. Okay, so just like Julianne's lemonade stand, open a new business, gets a bank account, borrows, okay, receives cash from fees earned. Right? So a lot of transactions occurring. Oh, no. And what I didn't put scan in, but I have written here, is indicate the effect of each transaction and the balances after each transaction using what the textbook refers to as the integrated financial statement framework. What does that mean? This transactional analysis using the integrated financial statement framework. It's exactly this. Okay, so I'm going to analyze every transaction with respect to the accounting equation. So, if he opened a business bank account in the name of Woods Insurance Inc. with a deposit of $40,000 in exchange for capital stock. First of all, I find that a bit ambiguous. I think what they mean to say is that they issued capital stock. They received $40,000, okay, from a shareholder. Okay, and they opened up a bank account and deposited. Okay. I am taking that sentence to mean they issued capital stock, received $40,000 in exchange for the capital stock, deposited the money into the bank account. Okay. I would never be this ambiguous. I find that a bit ambiguous. So, with respect to the accounting equation, how have things changed, if at all? Cynthia? Right. Oh, I forgot to put labels. So cash is increased and capital stock. All right, so both sides of the accounting equation are going up. Yeah, we call it cash. I mean, we could call it bank account, but what we really mean is cash, and most businesses will just call those accounts cash. Yeah. All right, does everybody see how the accounting equation's been affected here? The business has received cash, issued shiny new share certificates, okay, capital stock, okay, and now they have an owner. I know it's a bit ambiguous the way that they've worded it, but I'm rewording it. They issued capital stock, received $40,000 cash, opened a bank account, put the money in. Okay. So cash is going up under the asset side of things. And under the equity side of things, we've got now a stock account, capital stock account, sometimes called share capital, $40,000. Next transaction, borrowed $30,000 by issuing a note payable. Well, first of all, what is this note payable? They're referring to a promissory note. So if you ever borrow money from a bank, even on a student loan, you're going to have to sign a promissory note. It's just you that signs it. I promise to pay the bank oodles of money on this date with this interest rate, and all the terms and conditions of that loan, okay, are going to be on a promissory note. And from the business point of perspective here, their point of view, they call that a note payable. Okay. So how is this signing a note payable, or what they call issuing a note payable, and borrowing money, how has that affected the accounting equation? Yeah? Right, 30, that's right. Right. Okay, and they're calling it a note payable. Okay. So cash is going up by 30,000. I guess I should label these two. That's A and that's B. Right? Cash went up. At the same time, on the other side here, the accounting equation, note payable is going up. Okay? Received cash from fees earned, $28,000. How has that affected this accounting equation? Cash increases, great. It's always nice to get cash in the bank, 28,000. Something else on this side go up? Revenue, right, which sort of ties into that special account retained earnings. And I'm going to start referring to it as R/E retained earnings. Okay? Only because I'm running out of space, but that is the common abbreviation for it, okay? Retained earnings. Because we know, going back to our expanded accounting equation, that if we make a sale, it will increase retained earnings, increases equity, right? We already established that. Right. And that was C. Everybody see that? D, paid rent on office and equipment for the month, $3,000. How has that affected the accounting equation? It's expense, okay, so that means retained earnings, right? Going back to that integrated financial statement approach. What else has changed? Cash, right? All right, so both sides of the accounting equation going down by the same amount. E, paid automobile expense for the month, $1,800, and miscellaneous expense, $900. Another expense, paying cash. So it's going to be very similar to our last transaction. So I'm just adding them both up together, the 1,800 and the 900. Okay, so I'm saying cash is going down by 2,700. It is there are two expenses, but I'll just summarize them here as minus 2,700. Okay. What else? Paid office salaries, 4,200. How has that affected the accounting? Cash going down. Right, I heard that. What else? Retained earnings, right? It's an expense. If we pay office salaries, it's like a salaries expense. It didn't actually come out and say expense. These other ones have, the automobile expense, miscellaneous expense. But this is also an expense. Paid interest on the note payable. Cash going down, right? Minus 100. What else? Has the note payable gone down? No. It's interest expense. Okay. Anytime you pay interest, that's an expense for that business. If they had paid down the note payable, they'd say something like, oh, we paid down the principal on the note payable. H, purchased a land as a future building site, $55,000. What's going on here? cash went down, right? We see that. And what was it? Land. We're going to create another account then. Because land is going up. So the net effect here on this side of the accounting equation is 0. Okay, so up and down, which is fine. Paid dividends, $2,000. How has that affected things? Right. And we know that dividends tie into retained earnings. $2,000. Oh. To the bottom, eh? Okay. So they asked us to actually calculate the balance after each transaction, but I didn't. But I will calculate the balance now, except I've run out of room. So let me just keep that up there. So on my separate sheet, I'm going to indicate all of the balances. Not very nice. Not very pretty, eh? When I do it this way. There's 3. All right. So here are my new balances. Okay. And what's always important to do is to make sure after you're done this calculation, do my total assets now equal my total liabilities and equity? Does my balance sheet equation balance here? So the total on this side, we get 86,000. And 30 and 40 and 16, yes. And on this side is also 86,000. Okay, I'm using sigma, just a sum. So those of you scientists know what I'm talking about. All right, so the total of this side, total of that side. Okay, so it is in balance, which is a good thing. So my assets equals liabilities and equity. Okay, so we are now in a good position to prepare the financial statements. Okay, for the month of September here. Okay. What statement do we always prepare first? Income statement. Always, always, always. And in order to do that, we really have to look at the retained earnings column here and identify which ones are pertinent to net income and the calculation of net income. I do know that, I can recall that all of these first transactions anyway had to do with the income statement. And that this was a dividend item here, my last one. Okay. So I'm going to take these items now and use them for my income statement. Okay. I don't know what he calls his business. Woods Insurance, there it is. Okay, do I put it as at July 31st or for the month ending July 31st? For the month ending, yes. Okay, so we generally list revenue. We've done this before, so this should be a lot easier to recall the second and third time around. He did have fees earned. That's what he's calling his revenues. And I'm just going to go back to my summary here. The fees earned, that was in transaction C. Okay, I know it's an income statement item, 28,000. Expenses are next. Okay. And I know that all the transactions after that, if I go back to my summary, so D, E, F, and G, those are all expenses. Okay. Right, so D, E, F, and G, these are all expenses. Okay. So rent expense on office and equipment, for the month, 3,000. Automobile expense, 1,800. Miscellaneous expense, 900. Salaries expense. Interest expense. Oh, well, that's just wrong. All right, so I get net income then of $18,000. All right, so what's the next statement? Retained earnings, right. We need this number actually for the statement of retained earnings, so that. And this is another one where we're looking at the activity for a period of time, so for the month ending. So we're not going to say as at. What was the opening balance in retained earnings, by the way? Zero, yeah, just started. It was just like Julianne's lemonade stand in the example. So we add net income. So we're going to add that $18,000 from the last statement, okay, the income statement. Then what do we do? Minus dividends. Very good. Now, where do we get that information? Again, we go back to that summary sheet. And we had identified here in the retained earnings column, okay, that was revenue and expenses, that was income statement. We also identified here the dividends. Okay, so we know it's all flowing through the retained earnings account. I'm going to subtract out 2,000. There we go. So the last one that they're asking us to prepare here, balance sheet as of July 31st. I'm not going to have enough room here. They're also asking us, just by the way, for a statement of cash flow, which I don't really want to get into in this course. I introduced it in Chapter 1, and that'll be it, statement of cash flow. All right. Where do we get our information for balance sheet? Oh, it's just all wrong. We're going to go back to that summary sheet again. So we go back to our summary sheet. We had calculated the balances in each of cash and land and note payable and stock and retained earnings. Those are the numbers we're going to put on our balance sheet. That's simply what we're going to do. Assets. Oh, this is such a simple business, eh? Cash and land. And then we have only one liability. That makes it very simple. And I often get asked, if there's only one item, do I have to show a subtotal for liabilities? No. Got one item. There's the subtotal. Right there. The textbook seems like to call it stockholders' equity, and I like to call everything shareholders' equity. So it means the same thing. Stock, share. I'm just pulling off the balances off of my summary sheet. I could have also gotten the retained earnings too off of this last schedule, the last statement. Oh, I'm running out of room. Okay, I'm going to squeeze it in. 86,000, because I don't want to go to another sheet. Okay. All right, so our balance sheet balances, phew, it'd be so embarrassing if we hadn't done that. Okay. Any questions about either the transactional analysis or the preparation of the financial statements? Good. All right. Well, that's the end of Chapter 2. Today, I was supposed to do Chapter 3. So what I'm going to do is start Chapter 3. I don't know if I'll be able to finish it. But we'll see. Okay, so again, more building blocks, eh? We're got introduced to financial statements in Chapter 1. Chapter 2, got introduced to transactional analysis. And now we're going to throw a curve at you. Introduce something called accrual accounting. Right? So we've got certain rules, essentially, about when we can record revenue and when we can record expenses, okay? Which we really didn't get into in Chapters 1 and 2. Okay? We just said, yeah, they incurred this expense, they received this revenue from sales or whatnot. And I really didn't tell you what are the rules for revenue and what are the rules for expenses. And that's what accrual accounting is all about. Right? So, basic accrual accounting concepts means the matching concept. That tells us when to record an expense, actually. Accrual concepts will guide us as to how to, when to. It's actually more when, okay? When to record transactions. We're going to look at adjusting journal entries, adjusting transactions, adjustment process. And if you notice, too, there's one thing that's been missing from my whole vocabulary that keeps slipping out every now and again. Something called a journal entry and something called a debit and credit, another thing called a general ledger. Okay? In this course, I don't talk about that. Okay? But that is what we see in real-life accounting systems. We see debits and credits, and we see something called a journal entry and a general ledger. Okay? I am just going to revert back to the accounting equation, okay, and analyzing transactions with respect to this. But in the real world, we convert these pluses and minuses to debits and credits, and we update the balances on a general ledger. Okay, we call these things journal entries whenever we have debits and credits. But you don't need to know about it in this course. This is a completely different accounting course. I will not tell you the rules of debit and credit. I will not talk about updating the general ledger or preparing a journal entry. And I just made it slip there when I talk about the adjustment process. I almost said, I did say adjusting journal entry, but this is not what I'm going to actually say in this class. I'm just going to call it the end of period adjustment process. Then we're going to continue that through. We're going to prepare financial statements, okay, and then just talk about why should we have accrual accounting, all right? So, like I mentioned earlier, accrual accounting sets down the rules, okay? So, let's say you're a manager on my favorite soap opera, Young and the Restless, okay? So you work for Chabot Cosmetics, okay? You're Ashley Abbott. And who's working there now this week? It's Jack Abbott is working, and who did they offer a job to this week? Victoria Newman, all right? So, they are the executives, and they run, and it's ultimately run by Tucker McCall, Chancellor's, Kate Chancellor's son, long-lost son. Anyway, so I know there's a few of you who watch Young and the Restless, right? Okay, so just Marie and I, we watch Young and the Restless. Anybody else? Nobody's admitting to it? Okay, so if you're Ashley Abbott, I think to this week she's the CEO. They change all the time. You're going to need some rules about when to record revenue. Okay, so they make a great big sale of their cosmetics, their makeup, they've got perfume lines, they got all sorts of things going on. When do they actually record that sale? She's going to need to know that. Okay, is it when they sign the order with the customer? Does she record the sale then for the cosmetics? What do you think? Should it be whenever she delivers the cosmetics and sends it off to the customer? Or should it be whenever she receives the cash for it? When cash is received? How about, so there's 3 parts here. She's signing the order, she's delivering the cosmetics, sending it out by the delivery truck, and then she receives the cash. When's the best time to record the revenue? So somebody said the time the cash is received, which, yes, you are virtually certain at that point that revenue has been earned. Anybody else have any other opinions? When you send it, when it's delivered. Okay. And that's actually what the CICA handbook says, is when we've met 3 tests. Okay. So why is accrual accounting needed? So here, what I'm trying to show is your Ashley Abbott. Oops. This is all wrong. Contract is signed. This is a timeline. Okay. Do you record revenue at this point, or this point? And actually, what the CICA handbook says is whenever it's delivered. Okay, upon delivery. And why is that? There it is. The revenue recognition principle is why that is. The performance must be achieved. This is straight out of the CICA handbook. Okay, this is the revenue recognition principle, which means, for the rest of us, what performance means, delivering the goods or performing the service. Okay, so you've done something. The amount is reasonably measured. Okay, you can actually, you know, okay, it's worth, the sale is worth $10,000 or whatnot. And the collection of cash is reasonably assured. Okay, so even though you might not have received the cash yet, as long as you're reasonably assured that you will. Okay? So these are 3 tests that must be fulfilled in order for us to say, yes, Ashley Abbott should record the revenue at this point. Okay? So that's what defines that. Now, sometimes we receive the cash in advance of actually delivering the product. Okay? And that's, I guess, what this slide is trying to show, is sometimes the cash is received at the beginning and, you know, delivery occurs, you know, subsequent to it. Okay? You still don't record the revenue until delivery. Okay? Because remember, that first test was performance is achieved. Deliver the good, perform the service. Okay? So in that case, if you receive the cash in advance, which can happen, you might ask for a deposit, or you might ask for the entire amount of the sale up front. Okay? You still don't record that revenue until you deliver. Ashley Abbott doesn't record the revenue until she delivers the cosmetics. Often, though, times what happens is you deliver the good and cash is received afterward. Okay? Like in my first example, you still record the revenue here, okay, when at delivery. Right? So that's what accrual accounting tells us. Right? So that is different than the cash basis of accounting. Cash basis says there is no transaction until the cash is actually received. Accrual says no. Okay? It doesn't really matter when you receive the cash, as long as all 3 conditions of the revenue recognition principle are satisfied. Right? The other thing about accrual accounting is, when do we recognize expenses? It's the other side of it. Because sometimes Ashley Abbott can pay for cash in advance, pay her cash in advance of actually incurring the expense. Okay, what does incur the expense? It means you've used something up. Okay, you've received the benefit of something. But also, you want to match your expense to the revenue in the period that it's recorded. So it's not uncommon, if I take my timeline here, to pay cash in advance of actually receiving the benefit of something, okay, or giving rise to revenue. Right? So perhaps Ashley Abbott at Jabot Cosmetics has paid money today for an ad that's going in Restless Style next year, or next month, or next issue. Okay, so Restless Style and Young and the Restless is it's a magazine. Okay, so if she's put an ad into a future issue of a magazine and she pays today, okay, she hasn't incurred an expense yet, okay, because she hasn't received the benefit of that. Okay, and similarly, the matching principle says, well, you can only record the expense in the same period as the revenue. So that ad isn't generating revenue for you until the next issue, next month or next year or whatever it is. Okay. So even though she pays the cash today, we're going to treat it as a prepaid expense until we get some revenue from it. Okay. We're going to match the expense to the revenue. That advertising gives rise to revenue, we record it then. Right. Could also be the opposite. The issue of the magazine goes out, the advertising, okay? The advertising goes out, and Ashley doesn't pay Billy Abbott at Restless Style magazine until after the issue has been put to press. Okay? So cash could be paid later. Right? In that case, still, you record the expense, okay, when it's incurred, when it gives rise to some revenue. You're going to match your expenses to your revenue, record the expense the same period as the revenue that it gives rise to. Okay? So we call that the matching principle. Okay, so there are two principles here that are guiding accrual accounting. Okay, one of them is the matching principle. Expenses incurred to generate revenue. When expenses are earned and recorded, all expenses incurred in generating that revenue are also recorded. Okay? So it's like your expenses are chasing your revenue items all the time. Okay? And you're not going to record the expense until the revenue that it's giving rise to is recorded. Okay? And going back to revenue recognition principle, 3 tests before we can recognize revenue. Okay? Deliver the good or the service. Okay? You have to be reasonable, you have to know the amount, and you have to be virtually certain, or reasonably assured you're going to receive the cash. All right. So let's just introduce accrual concepts here at Julianne's Lemonade Stand. Okay, so it works even in these small little businesses. She sells glasses of lemonade, right, to customers. Sometimes she gets payment in advance. Sometimes she gets payment later. Okay, that can happen. But revenue will always be earned when the glass is provided to the customer. So at the moment that she says, well, here's your glass of lemonade, that's when she's earned the revenue, as long as she's certain of collection. Expenses, on the other hand, incurred for items for her supplies. Okay, so expenses are incurred for items such as supplies where payment may be made in the future. You're still going to record the expense in the same period as the revenue. Expenses are recorded as they are incurred, not as they are paid. Let's see this in action. Okay. Julianne signs a contract. She's going to sell 50 glasses of lemonade at a local soccer tournament. Okay, so I live very close to this gigantic soccer pitch called Hornet's Nest. All right, so let's say she gets a contract to sell lemonade at the local soccer tournament. There's one almost every weekend. So she's given $50 in advance, right? So her cash is going up, right? And it's always easy to identify that part of the transaction. Assets going up. But yet, she hasn't yet provided the good. She hasn't delivered the 50 glasses of lemonade. So we can't record the revenue just yet. We're going to have to put that other part of the transaction somewhere else. Okay? And that somewhere else is in a liability account, okay? Because she is actually liable now to provide that good. Okay? So we've got this new account I'm introducing here. It's a liability account called unearned revenue. It's sometimes called deferred revenue because we are deferring the recognition of it. Okay? And it's going to be recorded as a liability, unearned revenue. Amount received reported as a liability until the revenue is actually earned, which means until she provides the lemonade, it's going to stay there as a liability. Okay? So that's the other part of the transaction. Liabilities are going up, assets are going up. Okay. Let's see another transaction here that accrual accounting is giving rise to. She's expanding and she's renting out, a spot for her lemonade stand, and the landlord has said, "Oh, you have to pay next month's rent today." Okay, but yet she hasn't recognized the revenue for next month just yet. Okay, so she can't record the expense as a result, because remember, the matching principle says record the expense in the same period as the revenue that it's giving rise to. Okay? So what she's created is an asset. She's prepaying next month's rent. Okay? So she's got this item that's of future economic benefit to her. Okay? So cash is going down. That's pretty obvious. prepaid expenses, though, are going up. She can't record that expense until she's recognizing the revenue from it, which won't be until next month. So amount is reported as a prepaid expense until the rent is actually used up and the revenue that it's giving rise to is recorded. Right? And companies pay a lot of items in advance, and even you do too. What of your expenses do you pay in advance? Movie tickets, yeah. You can go online now and buy the ticket a week ahead of time. And if you were to make your own personal balance sheet, you have a prepaid expense there, certainly. Anything else that you pay in? Yeah. Well, the same thing. What else do we pay in advance? What service or good do we pay in advance? Yep. Your cell phone. That's often. Some of you I know have got the pay-as-you-go plan, but some of us pay in advance of the cell phone service. Okay, so I've got a cell phone bill like that. Okay, so I pay, I think it's like $35 a month, unlimited text and local calling. But I actually take a look at that invoice. I'm paying it in advance. Okay, so I get an invoice today. You know, it's the middle of September for the middle of the period from the middle of September to the middle of October. Take a good look at that if you're on those sorts of plans. What other things do you pay in advance? Plane tickets, exactly. You pay today, the flights next week or at Christmas or whatnot. For your own personal balance sheet, that's a prepaid expense. It's an asset, right? There's a future economic benefit there. What other things? What? A loan isn't really any. What else do we pay in advance? Tuition fees, yes, exactly. Do you pay for one term at a time or 2 terms? You could opt for the one huge payment? Yeah, and so you have yet to receive the benefit of all of that, right? So yeah, you have a prepaid expense. Some of you who rent apartments, you probably have even more prepaid expenses, right? So whenever you signed the lease, you paid for 2 months' rent. Which 2 months? First and last. So that last month's rent you have yet to receive the benefit of. Okay. What else might you have paid in advance in your apartments? Internet, yes. Okay. They're going to give you a bill today. That will be from coverage today till the middle of October. Okay. That's how Bell and Rogers all work. If you've got a home phone, it's the same thing. If you've got cable, it's the same thing. Or satellite TV, it's the same thing. We pay for all these things in advance. Anybody a season ticket holder of the Senators? Shay? What? You're too poor? I can't even afford that. I don't even know how much it is, but I know I can't afford it. I can't even afford to go to one game, let alone the whole season. Anyway, you pay in advance for a whole season you have yet to receive the benefit of. Okay? So that's exactly what's going on here in their small little lemonade stand. They're paying for something in advance of actually receiving the benefit of it, meaning receiving the benefit, generating the sale in this case. All right, so it's going to sit on their balance sheet until they actually use it up. Okay. Now, supplies. It's another thing, haven't necessarily received the benefit of. She's buying supplies. Julianne bought $10 worth of supplies. She's yet to use them up in generating revenue. Okay. So in this case, supplies have increased by $10, and that is another asset. She hasn't yet paid them. It's what we say on account. So her accounts payable is going up. That's a liability. So we record the asset as an asset. We record the supplies as an asset until they are used up. Okay, that's what we're saying there. Big one. Purchase of equipment. All right. So Julianne bought some more equipment. The total cost was $70. She paid $10 cash down payment. She agrees to pay 6 additional monthly installments of $10. So the equipment is an asset that's going to give her lots of future economic benefit, right? That is an asset, right? Cash went down by $10. Okay, and on the other side of things, she agrees to pay the supplier over 6 months, whatever, $10 each. So liabilities going up. So this is, if I was teaching another course, I'd say this is a compound journal entry. But in this class, the net effect here on this side is 60. Okay, so it's an increase of 60. Here we also have an increase of 60. As long as the net effect is the same, we're good. Oh yes, Julianne also sold some lemonade at an office summer barbecue this month. The company will pay her later. Okay? So she has a promise to pay. It's an unsecured creditor, they promised. And we call that accounts receivable from her perspective. Right? So this promise to pay, she's got customers who owe us money. We call that accounts receivable. And sales are going up, so we know that retained earnings and equity are also going up. She serves 100 glasses of lemonade at a roadside lemonade stand. This is fairly straightforward. This is not demonstrating accrual accounting. It's just I wanted to have just a regular sale. So this fits all of the 3 tests of revenue recognition. She knows the amount. The good has been provided. She's reasonably assured of collection because she actually has received it, right? The sales also goes up on the other side. Then she actually receives the $150 from the office summer barbecue. So that was a transaction we started 2 or 3 slides ago. We're actually receiving it now. So she's received the cash. So assets are going up, but at the same time, assets are going down. The accounts receivable balance, the balance that her customers owe her, is also going down. Then we paid for the supplies that we bought earlier. So remember that supply purchase on account. Okay? We're going to pay our supplier. So our liabilities are going to go down, $10. Cash also will go down. What else? I incurred some more expenses for the month of October. Okay? Wages, rent, advertising, utilities. This is fairly straightforward. But again, I put this in just to demonstrate this matching principle. These expenses have given rise to revenue in this period. Okay? So as long as that is occurring, we're respecting the matching principle, then it's okay to record the expense. So we've received the benefit of the wages expense, and that has given rise to revenue. We've received the benefit of the rent, and that's given rise to revenue, etc. Mom gets another dividend, $4 this month. All right. So I've summarized this, similar to what I did in Chapter 2. Summarized all of this, okay, to get up-to-date balances in each of my asset accounts, liabilities, and shareholders' equity accounts. Okay. I'm realizing I'm running out of time yet again. The next set of slides has actually got to do with the adjustments. So I think what I'm going to do is just, leave it here because this is going to take much longer than just a few minutes to go through. So if you haven't already done it, I will be taking up a problem in class next week that goes with this chapter, P3.1 and P3.2. Okay, so what I'll do next week is I'll continue on with the adjusting process, okay, and then we're going to do 2 of the problems in the textbook. If you could do that, you'd be in good shape. Okay, remember, stay on track. All right. So have a good week. I'll see you next week.